Welcome back, guys. Today we're going to take a look at Hilton. And now Hilton is basically a hotel company, and they do mostly upscale luxury hotels. Now, in the past 5 years, they are up 123%, definitely outpaced the S&P 500. Very, very strong performance by Hilton. They pay a very small dividend. They're a $51 billion company, and their price to earnings ratio is 44, so quite high on the price to earnings ratio. And they did this all through basically multiple expansion because in the past 5 years, they went from 880 million to 1.14 billion in net income. So they didn't even do 50% more in net income, but their share price grew by 123%, which is kind of crazy. So their price didn't really follow their fundamentals all that much. Um, Checking out their growth, so from 2017 to 2018, that's probably due to an acquisition, and then they've grown pretty solidly out of the 2020 thing that we had. Otherwise, in the past few quarters, they've grown by about 6, 12%, so probably like 10%. And then it translates pretty well into net income at like a 10, 11% rate. Also, they buy back lots of stock. You can see that in their shares outstanding. Taking a look at their balance sheet's kind of rough. Um, they have a lot of debt and they don't really have a lot of assets. So they actually have negative book value. So that's not really a great sign, but it's not that big of a deal, especially since um, this company is more of a franchise company, so like it like it's obvious that they don't really have a lot of assets, but it's mostly just brand assets, and then their liabilities were to acquire those brands. And as long as their interest rates are quite low, then the net debt's not too bad. But net debt of 9.5 billion, we're definitely going to have to take that into account when we do our cash flow model. In terms of cash flow, what do they do? Well, they buy back tons of stock. They bought back 2.3 billion in stock last year, and they're projected to do 2.8 billion in stock buybacks this year. That's what management says, so it's pretty crazy. Yeah, they pay a small dividend. Pretty, yeah. I don't even know why they pay a dividend. It's so small, and yeah, their cash flow is also higher than their earnings, most likely due to stock-based compensation of some sort, I would think. In terms of stats, their return on invested capital is okay. It's not amazing. Their gross margin is around 25% and translates into a net margin of between 10 and 14%, 10 and 15% or so. I actually took a look at a lot of their slides. So here we go. This is their debt structure, 85% fixed at a 4.9% interest rate. And much of it is due in about 5.8 years. So it's not like super, super long-term debt. Uh, the so it's a fee-based business, so they generate um, most of their money from franchise fees and licensing fees as well. And they also increase their fees by 10% every single year from 2009 to 2024. So they increase their fees on the people actually running the hotel, and then they basically buy back stock with that money. Um, in terms of what they own, well, they own tons of different brands. These are all the brands that they own. It's pretty crazy. They pretty much grow and then they go acquire a brand and then they acquire another one until I mean, I guess they're just trying to build a monopoly in hotels. Um, yeah, pretty nuts on how many hotels they've been able to acquire over the years. Um, yeah, they're expected to do about 5% in net unit growth for 2023 or 2024. Or that's what they did last year in 2023. They grew by 5%, and they're probably expected to do about that next year as well. So yeah, they are definitely focused on growth and acquiring businesses and opening up new hotels so that they can get more franchise fees. So yeah, definitely focused on growth. What do the analysts think? Well, actually, also Bill Ackman owns a huge stake in this company. So this is Bill Ackman's portfolio. He owns a large stake in Hilton. So that is a good sign. It means that he believes that Hilton is a good company to invest in. So let's take a look at what the analysts think about the earnings. They're thinking 7.11 going up to 8.26, and in terms of revenue, they're thinking 11 billion going up to 12 billion, a 10% increase, and then an 8% increase into 2025. Because yes, they are focused on growth. However, it becomes harder and harder to grow it since they're already such a large company with so many different brands. Let's take a look at their stats. Their short percentage is 1.39%. That's quite low, so that's a good sign. Let's take a look at the model here. So I put their earnings estimate here, revenue estimate here, buybacks of 2.7 billion, net debt of 9.5 billion, discount rate of 10%, exit multiple of 22. Now the reason I have the exit multiple at 22 is because this company is going to become a slow grower at some point. At some point, you just have so many hotels that it becomes difficult to grow from there. And then 22 is also somewhat higher because, I mean, yeah, they'll be growing, but it will still be pretty steady growth, and they have some like network effects and pricing power that like their moat is pretty strong. So I think 22 is fair. You could maybe push this to like 24, but I think 22 is okay. And in terms of growth, I have them growing at 10% and then slowing down to 6% in their earnings and also with their revenue. Now, projected growth margin at 15%, that's kind of high because last year they did like 12% in profit margin, and their highest profit margin they ever did was 14%. But the analysts think that they can do 15% this year, so that's what I have them down as. And I just project that going straight into the future. They might be able to grow this profit margin maybe a little bit, but also it could easily fall back down to 12%. And also, there are risks in this business in case we have a recession. Definitely, this company is going to get hit. And yeah, more affluent people buy hotels at these places. So if the stock market takes a hit, this company is also going to take a hit because a lot of the wealth of the wealthy is tied up in the stock market. So hopefully that makes sense to you as well. But yeah, definitely risks in this business. It's it's very 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 highly priced with a price to earnings ratio of 44 right now, and that's why we're seeing the fair share price with these growth numbers at 156. So yeah, I would say it's overpriced right now. I definitely wouldn't touch it. In fact, if I owned this company, I would be thinking about selling it. And now the company is projected to do 2.7 billion in buybacks, even though they won't have that much free cash flow. So they'll probably take out debt in order to do those buybacks. But buybacks do have a tendency to push the share price higher. So over the next year, you could probably expect the share price to be flat to higher. And I would personally be trying to get out sometime this year or next year. Uh, but yeah, I definitely wouldn't buy into this company. Well, unless I want to ride it for a short-term gain. But yeah, profit margin of 15% is still quite high. Maybe they grow by a little bit more. So it's definitely possible that they could grow by like 10% a year. Just because their fees keep going higher and they are expanding their presence. So maybe they grow by 10% a year. Even in this case, they are overpriced. They could also expand their profit margin maybe up to 17% at some point. And if they do that, then they're probably fairly priced. So I feel like this is a really optimistic scenario. And even in this case, they're overpriced when you account for debts. So yeah, that's what I think. Let me know what you guys think in the comments. And then also, if you want to try the spreadsheet for yourself, just check the link in the description. I let anybody use it for free. So yeah, pretty cool there. And make sure to hit that like button. I'll see you in the next video.